Before we begin today's discussion, a brief word. If you're looking for a place that approaches financial markets with discipline, clarity, and respect for your intelligence, consider subscribing to this channel. We don't chase headlines. We don't promise overnight wealth. We examine markets the way serious investors do, with patience, historical perspective, and rational analysis. If that approach resonates with you, the subscribe button is below. Now, let's turn to today's topic. Something unusual is happening in the gold market. Not unusual in the sensational sense. Unusual in the statistical sense, the kind of unusual that appears in historical data perhaps once or twice in a decade, if that. Gold has just generated a technical signal that, throughout modern financial history, has preceded significant price movements. Not always upward, not always immediately, but always significant. This isn't about speculation, it's about pattern recognition. It's about understanding what markets are communicating when enough participants act in concert to create statistical outliers. Today, we're going to examine this signal with the seriousness it deserves. We'll explore what's actually happening in gold markets right now. We'll look at the historical precedents. We'll discuss the macroeconomic forces that may be converging at this moment. And critically, we'll talk about what this means for your capital, whether you currently hold gold, whether you're considering it, or whether you're simply trying to understand what this signal suggests about the broader financial environment. This discussion requires focus. It requires setting aside both fear and greed. It requires thinking like an investor, not a gambler. Let's begin. First, we need to understand exactly what signal we're discussing. Gold has broken above a multi-year consolidation pattern while simultaneously showing divergence in several key technical indicators. More importantly, commercial hedgers, the actual producers and industrial users of gold, have reduced their short positions to levels not seen since 2018. Why does this matter? Commercial hedgers aren't speculators. They're companies that mine gold, manufacture with it, or use it in industrial processes. Their positioning in futures markets reflects real economic calculation, not market sentiment. When these participants dramatically reduce their hedging activity, they're essentially saying they're less worried about downside price risk. They're comfortable holding more exposure to the physical commodity. This behavior, combined with technical breakouts and specific momentum characteristics, creates what analysts call a confluence signal, multiple independent indicators pointing in the same direction. Historically, when gold generates this particular confluence, what follows is rarely subtle. Let's be clear about something important. Markets generate signals constantly. Most are noise. Most disappear into the statistical background without consequence. What makes certain signals rare and worthy of attention is their historical track record and the underlying logic that explains why they work. The signal we're discussing today has appeared approximately 8 times in the past 30 years, depending on how strictly you define the parameters. In 7 of those 8 instances, gold moved more than 15% within the following 12 months. In 5 instances, the move exceeded 25%. One instance resulted in minimal price change, a reminder that no signal is infallible. But here's what matters more than the statistics. The logic makes sense. When commercial hedgers reduce shorts, when technical patterns break after extended consolidation, when momentum indicators show specific characteristics, these things happen because the underlying supply and demand dynamics are shifting. Rare signals matter not because they're magical. They matter because they reflect genuine changes in market structure that don't occur frequently. To properly contextualize this signal, we need to understand where we are in gold's longer market cycle. Gold doesn't move in straight lines. It moves in waves. Extended periods of accumulation, followed by sharp advances, followed by consolidation, followed by either continuation or reversal. From 2011 to 2015, gold was in a bear market. From 2015 to 2019, it consolidated. From 2019 to 2020, it advanced sharply. Since 2020, it's been in another consolidation phase, albeit at higher levels. Consolidation phases are not dead periods. They're periods where markets digest previous moves, where weak hands exit, where new fundamental conditions develop. The longer a consolidation, the more energy builds for the eventual resolution. Think of it like a coiled spring. The compression itself isn't dramatic, but it creates the potential for dramatic release. Gold's current consolidation has lasted several years. During this time, the underlying conditions supporting gold, which we'll discuss shortly, have not disappeared. They've intensified. This is why the current signal carries weight. It's not appearing in isolation. It's appearing at a moment when the fundamental case for gold has been building quietly beneath the surface. Every market is composed of participants with different time frames, different motivations, and different emotional states. Understanding this psychology is critical to interpreting signals correctly. In gold markets specifically, we have several distinct groups. We have long-term holders who view gold as wealth preservation. We have momentum traders who chase breakouts. We have hedgers managing business risk. We have central banks accumulating reserves. Each group responds to different stimuli. When a rare signal appears, what's actually happening is that multiple groups are beginning to align in their behavior. This alignment is what creates powerful moves. But here's what most investors miss. The signal itself doesn't cause the move. The signal is evidence that the psychological and structural conditions for a move are now present. Fear of missing out drives late-stage buyers. Fear of loss drives panic selling. But in the early stages of significant moves, what drives price is simply the absence of sellers at current levels combined with the presence of persistent buying. This is where discipline matters most. The time to make rational decisions is before the emotional intensity increases. Once fear or greed fully activate, clear thinking becomes exponentially harder. Right now, while gold shows this rare signal, but before any dramatic move has occurred, is when disciplined thinking has the most value. Now let's discuss the fundamental backdrop against which this signal has appeared. Gold doesn't exist in a vacuum. Its price reflects the intersection of multiple macroeconomic forces. First, monetary policy. Central banks globally have expanded their balance sheets by unprecedented amounts over the past 15 years. While some quantitative tightening has occurred, the base level of liquidity in the financial system remains historically elevated. Gold tends to perform well in environments where currency debasement, whether actual or perceived, is a concern. Second, real interest rates. Gold pays no yield, which makes it less attractive when real interest rates are high. When real rates are low or negative, the opportunity cost of holding gold decreases substantially. Currently, even with policy rates higher than they were in 2021, inflation-adjusted returns on cash and short-term bonds remain compressed. This environment is structurally supportive for gold. Third, geopolitical instability. We don't need to catalog every global tension, but the reality is that geopolitical risk hasn't diminished. If anything, the multipolar nature of current global relations creates persistent uncertainty. Gold thrives on uncertainty, not because investors want disaster, but because they want insurance against it. Fourth, fiscal dynamics. Government debt levels across developed economies are at peacetime records. The paths to managing these debt loads are limited: growth, austerity, inflation, or some combination thereof. Each of these paths has implications for currency values and therefore for gold's relative attractiveness. These aren't theoretical concerns. These are the actual conditions existing in the world right now as this signal has appeared. Let's look at history, not to predict the future, but to understand the range of possibilities. In 2005, gold generated a similar confluence signal while trading around $450 per ounce. Over the following 3 years, it more than doubled. In 2008, during the financial crisis, gold generated mixed signals due to forced liquidation. This is a reminder that crisis conditions can temporarily override technical signals. In 2015, gold generated a signal at the end of its bear market. The subsequent move was choppy, but ultimately led to the 2019-2020 advance. In 2018, another signal appeared. The following move was substantial, with gold advancing from roughly 1,200 to over 2,000. What these precedents teach us is not that history repeats precisely. They teach us that when certain conditions align, the probability distribution of outcomes shifts. Small moves become less likely. Significant moves become more likely. The direction isn't guaranteed, but the magnitude of eventual change tends to be meaningful. This is what rare signal means in practical terms. It means the market is likely preparing for a significant repricing, even if the exact timing and direction aren't certain. Gold doesn't exist in isolation from other markets. Its behavior often signals something about the broader financial environment. When gold generates bullish signals while risk assets are also strong, it often indicates liquidity-driven markets where all assets rise together. When gold generates bullish signals while risk assets are weak or volatile, it often indicates flight to safety dynamics or concern about currency stability. Currently, we're in a mixed environment. Equity markets are near highs in some regions, while showing volatility in others. Credit spreads are relatively tight. Volatility indices are elevated but not extreme. This mixed backdrop is actually important context for interpreting the gold signal. It suggests that what's driving gold isn't simple risk-off behavior. If it were, we'd see broader market weakness. Instead, what may be happening is that specific concerns about currency, debt, and long-term stability are manifesting in gold markets, even while other assets remain supported by economic growth and corporate earnings. This bifurcation, where gold strengthens independently of traditional risk on risk-off dynamics, is actually more significant than simple crisis-driven gold buying.
It suggests a structural shift in how investors are thinking about portfolio construction and tail risk. If you currently hold gold, either physical or through financial instruments, this signal creates specific strategic questions. First question, is your position sized appropriately for your overall portfolio and risk tolerance? A rare signal doesn't mean you should dramatically overweight any single asset. It means you should ensure your existing allocation is thoughtful and deliberate. If gold is already a meaningful part of your portfolio, the appearance of this signal might actually be a reason to rebalance. Not necessarily to exit, but to ensure you're not becoming accidentally overconcentrated. Second question, what is your time frame and thesis? If you hold gold as long-term wealth preservation, short-term signals are interesting but not actionable. Your thesis is multi-decade, and individual signals are just noise against that backdrop. If you hold gold as a tactical position, this signal suggests maintaining discipline about your exit criteria. Rare signals that lead to significant moves can also lead to overextension. Know in advance what conditions would cause you to reduce exposure. Third question, how are you holding gold? Physical gold, mining stocks, ETFs, and futures contracts all have different risk characteristics and respond differently to price moves. Mining stocks, for example, offer leverage to gold prices, but also carry operational and equity market risk. Futures contracts require active management and carry roll costs. Understanding what you actually own and how it behaves matters more than the signal itself. The key principle for existing holders is this: a bullish signal is not a reason to abandon discipline. It's a reason to ensure your discipline is working correctly. If you don't currently hold gold but are considering it based on this signal, different questions apply. First and most important, are you considering gold for the right reasons? Gold is not a get-rich-quick vehicle. It's not a replacement for a diversified portfolio. It's not a solution to broader financial planning problems. Gold is useful as a hedge against specific risks: currency debasement, systemic financial stress, geopolitical instability, and extreme market dislocations. If you understand these purposes and believe they're relevant to your situation, then considering gold makes sense. If you're simply chasing a signal because you fear missing out, that's emotional thinking, not strategic thinking. Second question, how much makes sense? For most investors, gold represents somewhere between 0 and 10% of a portfolio. The exact allocation depends on your age, wealth, income stability, and personal risk tolerance. A rare signal doesn't change these fundamental allocation principles. It might inform the timing of establishing a position you are already considering, but it shouldn't dramatically change the size. Third question, how should you gain exposure? For long-term holders with substantial assets, physical gold stored securely has advantages. It's truly outside the financial system. For most investors, gold ETFs that hold physical metal offer simplicity, liquidity, and lower costs. Mining stocks offer potential upside leverage, but come with significantly more risk and volatility. Each approach serves different needs. The signal itself doesn't dictate which approach is best for you. Your specific circumstances do. The critical principle for potential investors is this: don't let a signal override your broader investment discipline. Use it as one input among many in a thoughtful decision process. Regardless of whether you currently hold gold or are considering it, risk management principles apply universally. No signal, no matter how rare, eliminates risk. It only shifts the probability distribution of outcomes. This means position sizing remains paramount. A well-constructed position is one that allows you to remain rational regardless of short-term price movement. If your position is so large that daily volatility causes emotional distress, it's too large. If your position is so small that even a significant move wouldn't meaningfully impact your wealth, you need to question why you're holding it at all. The right size is one that matters to your portfolio but doesn't dominate it, one that allows you to think clearly through volatility. Stop losses are complicated in gold markets because gold can gap significantly on geopolitical events. Tight stops can be counterproductive, taking you out of positions right before the move you were positioning for. Instead of mechanical stops, consider portfolio-level risk limits. If gold grows to represent more than a certain percentage of your assets due to price appreciation, that's when you rebalance. Leverage is particularly dangerous with rare signals. When everyone recognizes a signal and leverages their positions, the resulting volatility can be extreme. The signal might ultimately be correct, but leverage can force you out before the thesis plays out. Conservative positioning, reasonable size, no or minimal leverage, clear thinking about timeframes is how you survive to benefit from rare signals when they do resolve. One of the hardest aspects of acting on rare signals is understanding that rare signal and immediate move are not synonyms. Signals indicate that conditions are ripening for significant change. They don't provide precise timing. Gold could move significantly within weeks. It could take months. In some historical cases, the initial signal was followed by another period of consolidation before the eventual large move materialized. This uncertainty about timing is precisely why discipline matters. If you make a thoughtful decision to establish or adjust a position based on this signal, you must be prepared to be early. You must be prepared to watch your position do nothing for a period. Patience is not passive. Patience is active discipline applied over time. The investors who benefit most from rare signals aren't those who time the exact bottom or top. They're the ones who recognize when probabilities have shifted, position accordingly, and then simply wait without constantly second guessing. This requires genuine emotional fortitude. It requires ignoring the daily noise. It requires avoiding the temptation to overtrade around a core position. Think of it this way, if the signal is genuinely rare and meaningful, then getting the position roughly right matters far more than optimizing the entry by a few percentage points. The hardest part of investing is often doing nothing after making a good decision. Let's address explicitly the errors that destroy capital when rare signals appear. Mistake 1, overconcentration based on conviction. Just because a signal is rare doesn't mean it can't be wrong. Just because the historical track record is strong doesn't guarantee the future. Betting so much on any single outcome that you'd be financially devastated if wrong is never justified. Diversification isn't lack of conviction, it's acknowledgement of uncertainty. Mistake 2, using leverage to amplify the position. Leverage transforms volatility into existential risk. Gold can swing 10 or 15% in a matter of weeks. With leverage, such swings can wipe out accounts even if the eventual direction is correct. The promise of amplified returns blinds people to amplified risk. Don't fall into this trap. Mistake 3, panicking during normal volatility. If you establish a position based on a longer-term signal, expect short-term volatility. Gold can drop 5% in days, then recover, then drop again. This is normal behavior, not a sign your thesis is wrong. Emotional exits during routine volatility are how investors snatch defeat from the jaws of victory. They position correctly, then get shaken out right before the meaningful move occurs. Mistake 4, abandoning other portfolio principles. A signal in gold doesn't mean you should ignore other assets. It doesn't mean you should stop rebalancing. It doesn't mean all your normal investment discipline goes out the window. Integrate the signal into your overall framework. Don't let it dominate everything else. Mistake 5, confusing the signal with a guarantee. No signal guarantees anything. The future is uncertain. Markets are complex. Unexpected events occur. The signal suggests elevated probability of significant movement, that's all. Treating it as certainty leads to overconfidence, which leads to oversized positions, which leads to devastating losses when things don't go as expected. Mistake 6, chasing after momentum has already accelerated. If this signal does resolve into a significant move, there will come a point where momentum attracts trend followers and late-stage buyers. This is typically when risk is highest, not lowest. If you're going to position based on this signal, do it now while conditions are still relatively calm. Don't wait until gold is making headlines and everyone is talking about it. Mistake 7, failing to define exit criteria in advance. Whether your exit is based on time, price, or changing fundamentals, know it before you enter. Decisions made in the heat of market action are almost always worse than decisions made during calm analysis. Write down why you're taking the position and what would change your thesis. Refer back to this when emotions run high. These mistakes are not hypothetical, they're the actual behaviors that destroy capital repeatedly across market cycles. Learn from others' errors rather than repeating them yourself. It's worth stepping back to consider gold's role more philosophically. Gold is not an investment in the traditional sense. It produces no cash flow. It generates no earnings. It doesn't grow or innovate. Gold is insurance. It's a store of value. It's a hedge against specific systemic risks. Understanding this distinction is critical to thinking about it clearly. You don't evaluate insurance based on whether you profit from it in conventional terms. You evaluate it based on whether it provides protection against risks you actually face. In a portfolio context, gold serves several functions. It provides diversification because its price drivers differ from stocks and bonds. When currency concerns or geopolitical stress increase, gold often moves independently of traditional assets. It provides optionality in crisis scenarios. In genuinely extreme situations, financial system stress stress, currency crises, geopolitical conflicts, gold has historically maintained value when other assets failed. It provides psychological stability for some investors. Knowing you hold an asset with thousands of years of history as a store of value can reduce anxiety during market turbulence. But these benefits only materialize if you hold gold with proper understanding and appropriate size.
A tiny position provides no meaningful protection. An enormous position creates concentration risk and opportunity cost. The signal we're discussing today is interesting precisely because it suggests gold might be transitioning from a quiet hedge to an appreciating asset. But even if that transition occurs, gold's fundamental role in your portfolio shouldn't change. It remains insurance that might occasionally produce gains, not a speculative vehicle for wealth creation. The appearance of rare signals in any asset class should prompt broader reflection about portfolio positioning. If gold is signaling potential significant movement, what might that suggest about the overall environment? It might suggest that currency stability concerns are growing beneath the surface of markets. It might suggest that trust in central bank policy is more fragile than market calm suggests. It might suggest that geopolitical risks are being underpriced elsewhere. None of these interpretations are certain, but they're worth considering. A well-constructed portfolio adapts to changing conditions without abandoning core principles. If gold is genuinely signaling something important about the macroeconomic environment, then thinking about how your entire portfolio is positioned makes sense. Do you have adequate diversification across asset classes? Is your equity exposure tilted toward quality companies with pricing power? Do you have sufficient liquidity for near-term needs? These questions matter regardless of what gold does, but a signal in gold can serve as a useful prompt to review whether your overall positioning matches current conditions. The goal isn't to make dramatic changes based on any single signal. The goal is to ensure your portfolio construction remains thoughtful and appropriate for the environment you actually face. Sometimes, the most valuable thing a signal provides is not a specific trading opportunity, but a catalyst for broader strategic thinking. If this signal does lead to significant movement in gold, volatility will increase. This is absolutely certain. Large moves in any direction create volatility. Participants with different time frames and motivations clash. Price discovery becomes more chaotic. Preparing for this psychologically is as important as positioning financially. Volatility feels different when you're actually in a position versus when you're imagining it abstractly. A 10% drawdown that you thought you could handle comfortably suddenly feels terrifying when it happens to your actual money in real time. A 30% gain that you plan to hold through suddenly creates the temptation to take profits and avoid giving it back. These emotional responses are normal, they're hardwired. The question is whether you prepare for them or let them control your behavior. Practical preparation means several things. It means sizing your positions so that normal volatility doesn't cause emotional overwhelm. It means writing down your thesis and exit criteria before the volatility begins. It means scheduling times to review your positions rather than checking prices constantly. It means understanding that volatility itself isn't the enemy. Poor decisions made during volatility are the enemy. One helpful framework is to imagine both the upside and downside scenarios in advance. If gold rises sharply, how will you feel? What might you be tempted to do? If gold falls after you enter, how will you respond? Mental rehearsal doesn't eliminate emotional responses, but it reduces their intensity. When you've already thought through scenarios, your brain recognizes them rather than treating them as emergencies. The investors who outperform aren't those who never feel fear or greed. They're those who feel these emotions but maintain behavioral discipline despite them. One final principle deserves emphasis. We must make decisions with incomplete information. We don't know whether this signal will resolve bullishly, bearishly, or inconclusively. We don't know the exact timing of any move. We don't know what external events might overwhelm the signal's implications. This uncertainty is permanent. It's not a problem to be solved. It's the condition under which all investment decisions are made. The investors who struggle most are often those who want certainty before acting. They want guarantees. They want to know the outcome in advance. This approach ensures paralysis. No investment decision ever comes with guarantees. The discipline of investing is acting rationally despite uncertainty. It's using probability, historical context, and logical analysis to make the best decision you can with available information, while acknowledging that any decision might be wrong. The signal provides information. It shifts probabilities, it offers context, but it doesn't provide certainty. Your task isn't to wait for certainty. Your task is to decide whether the available information justifies action given your specific circumstances, time horizon, and risk tolerance. Sometimes the answer is yes. Sometimes it's no. Sometimes it's partially yes. A small exploratory position that can be increased if your thesis develops supporting evidence. All of these responses can be correct depending on your situation. What's never correct is expecting the market to remove all uncertainty before you decide. We've covered substantial ground today. Let's bring it together. Gold has generated a rare signal, a statistical and technical confluence that historically precedes significant price movement. The signal appears against a macroeconomic backdrop of elevated debt, currency concerns, and geopolitical uncertainty. The signal doesn't guarantee outcomes. It suggests that probabilities have shifted. It indicates that the conditions for a meaningful move are present. How you respond depends entirely on your circumstances. If you hold gold, ensure your position size remains appropriate and your discipline remains intact. Don't let a bullish signal cause overconcentration or abandonment of risk management. If you're considering gold, ask whether it genuinely fits your strategy and risk profile. Don't chase signals emotionally. Make thoughtful decisions consistent with your broader investment framework. For everyone, remember the critical mistakes that destroy capital: overleveraging, overconcentration, emotional trading during normal volatility, and confusing elevated probability with certainty. Markets reward discipline and patience. They punish impulsiveness and greed. This truth doesn't change regardless of what signals appear. The months ahead may bring significant movement in gold. They may bring extended consolidation. They may bring unexpected events that override technical signals entirely. Your task isn't to predict the future with certainty. Your task is to position yourself thoughtfully, manage risk appropriately, and maintain emotional discipline throughout whatever unfolds. The investors who build lasting wealth aren't those who catch every signal or predict every move. They're those who think clearly, act rationally, and maintain discipline through uncertainty. The signal is interesting, it's noteworthy, it's worth considering thoughtfully. But it's not a reason to abandon the fundamental principles of sound investing. Stay disciplined, manage risk, think long-term, avoid emotional decisions. These principles matter infinitely more than any single signal, no matter how rare. Whatever you decide regarding gold, make sure your decision reflects thoughtful analysis rather than fear or greed. Make sure it fits within a broader strategy. Make sure you can maintain it with discipline regardless of short-term price action. The future is uncertain. That uncertainty is precisely why discipline matters. Good investing isn't about eliminating uncertainty. It's about behaving rationally despite it. Thank you for your time and attention today. If this analysis has been valuable, consider subscribing for more disciplined, thoughtful examination of financial markets. Until next time, stay rational, stay disciplined, and invest with patience.